Let's get going though with gold. Very much the diversifying asset of choice these days for those worried about equity market risks, fiscal market risks, life in general. So much so it's become a bit of a momentum trade, Alex. The price went above $3,000 in March, swiftly moved on to $4,000 this month, and has now slumped a bit. Aside from what I've just said, what can you tell us about the drivers of the rally and now the dip?
Yeah, I think if we were having this discussion a few years ago, then talking about gold slumping to 4,100 would make us laugh. But the recent weeks has seen a pretty significant run up. I mean, you talk about the 6 months it took to get from 3,000 to 4,000. It seemed like gold was on a track to just keep punching through those records. People took fright, I think, a little bit, or just took profits at the end of last week, dropping it from over $4,300 to about $4,080. The buyers came back a little bit this week. We're not going to provide an hour-by-hour commentary on it, but I think it's just this big rush of new entrants into the market. I say I think because the data's a little bit harder to get your hands on now that the US government's shut down. But what ETF buying shows is that there's been a huge inflow, and I think it's shown that people are pretty price independent. You'd say they just see it as an asset that's climbing. Let's get on board. There's a lot of
price insensitive, as it were.
Yeah,
they don't care too much.
Yeah, and what's been interesting, I'm going to out one of my friends here. He'd been building up a stake for 2 years. Parents in the jewelry business, quite familiar with it. He sold a fair bit on Monday at the potentially week low, and he's kind of kicking himself a little bit, but he wants to buy back in if it drops further. I think that's a pretty good representation of the mentality now. And because of these new entrants, which might range from hedge funds that hadn't previously held a lot, there's a lot of retail buying. You see lines out front of shops. Bar and coin sales are way up, according to World Gold Council figures, potentially at the expense of jewelry sales. But that volume coming into the market has pushed up the volatility because, what we as probably more conservative investors would see gold as just a chunk of a part of a portfolio that balances out some of the equity and cash risks. Not that we want to hold too much cash, but that's traditionally what it's been there for. And then now becoming more of a traded asset, it's changed the market a little bit.
I mean, there are so many buyers involved now, as you've alluded to. The end of Diwali was also blamed for a bit of the sell-off as well, some of that jewelry buying falling away. You've written a piece about this week, and one of the things discussed in there is because there are all these people involved now, long-term holders, short-term traders, everyone in between, that we might be in a situation where more volatility is par for the course. Against that maybe is the idea that now gold has risen so far, it's come off a tiny bit, is really its first dip of any kind for quite some time. People might think we're naturally in for a bit of a period of treading water, given its move so far. But conversely, it could be that first point. It could be that things are just pretty volatile from here on in for a while, given all those buyers involved.
Yeah, if I had a perfect answer, I'd probably be out making money now instead of responding to you. But the difficulty is balancing that stable base of ownership that includes central banks, for example. Part of the reason that this run-up has happened is that even while conditions were against gold, so you had rising interest rates, strong US dollar, the price continued to climb as China, Russia and Turkey, and a few other central banks kept buying large volumes of gold. So it provided a bit of a base to the market. More recently, that's been taken up by Poland, although China's sat out of it a little bit, although the government has encouraged people to privately buy gold. So that's also been a driver of these prices, that Chinese buying. But yeah, it does kind of enter the realm of you look at people chatting about it in the same terms as Bitcoin, and it's been jokingly called physical Bitcoin as well. I'm probably showing off my traditional biases here, but I'm not hugely interested in talking about gold as traditional Bitcoin. But it does. that lens has changed, or people even applying that lens to it shows where we're at the moment.
Well, on that subject, and on the subject of what we're talking about in general today, perhaps, which is the risk of a equity market sell-off, how might we expect gold to react in that scenario? Again, we discuss this in the piece because that's ultimately what the majority of people, you would assume, still do hold it for as a diversifying asset, as something that could do well in the event of everything else going wrong. How might that play out? Do we think that will still play out in the event of a sell-off? Again, we don't have all the answers, but what are the thoughts?
There's two distinct examples here, and I think the first one to go back to is when gold sold down from the previous record of about $1,900 an ounce that was hit late in 2011, and that gold tumbled back down to just over $1,000 an ounce over a 2-3 year period after that. Partly because investors were moving out of gold and into risk-on assets, so piling more into equities largely. And so that shows what happens when people have a greater risk appetite. But that feels like a long time ago now. And more recently, when you've had shocks to equity markets, so as we were realizing the extent of COVID in February, March 2020, and also Russia invading Ukraine and the quite immediate impacts to the energy markets there was initially a sell-off in gold. And that, as far as market experts have told me, it was just around people needing cash quite quickly to settle or balance out other positions. And so they were able to use gold in that circumstance to provide a fairly quick cash injection. And the question then is, if these valuations we see at the top of the US market are held as not so realistic or sustainable, and money starts to move out of it, which situation applies? Is it a risk-off scenario where people pile into gold further, potentially after a sell-off? Has the view of gold changed after this more volatile few months that we've seen? Because, gold has been bid up at the same time as what you call a fairly risk-on scenario. People are happily investing in equities, but at the same time, money's coming into gold. So we're at a kind of, everything everywhere all at once moment, which makes it a bit hard to predict. My assumption, which is, just backed up by speaking to smarter people than me, is that gold would still provide a bit of a cushion for people looking for somewhere to put money in an equity sell-off. But the extent to which it would move is hard to say. I think one thing that has come up covering gold in recent years is that it hasn't done what we've expected. And the old rules don't apply so much. So, gold moving inversely to interest rates and the dollar, they haven't applied in the exact same way. So what has happened is when those conditions have changed, so interest rates falling, the dollar weakening, that's kind of layered on top of that baseline gold buying from the central banks, and as part of this big de-dollarization move, and contributed further. So it's kind of, the gold market gets to have its cake and eat it too, seemingly.
Yeah, it's interesting when you say people are buying equities happily. I don't know if I'd necessarily agree. Some people, as we'll come on to, are probably buying them through gritted teeth and, hated bull markets, long in the tooth bull markets, things like that. But we'll come to that in a minute. Why don't we end by talking about the analyst outlook, such as it is, because what seemed to happen as soon as we went past 4,000 or 4,300 is everyone upped their price targets to 5,000, which may say more about analysts than about gold. But what's the general view there in terms of the outlook for the price in future?
Leaning on one in particular, HSBC's analyst, the beautifully named James Steele, their commodities expert, he shifted up to 4,600 for next year. That's basically an average forecast for the year. So it kind of, it sets him up to be both wrong and right at various times. But that the reasoning behind that is that, the momentum, the far broader market interest in gold, and also the shaky macro situation that we're in. A lot of this does come back to Trump, frankly, and there is an ideology behind gold as an asset that involves some skepticism, or even just some potential realism about how much governments are spending to maintain their debt piles, which seems to increase. It's largely governments in the West. And so that focus means you're going to want another asset that is obviously valued in different national currencies, but seems to have protected people for a fair while now. So it's all that thinking that goes into shifting a number from, just under 4,000 to well over 4,000, which is, they have sophisticated models, but it's also kind of looking your finger and sticking in the air as well.
Well, perhaps recent days have been a blip, perhaps not. We will find out. There's also just the mathematical situation, isn't there, where a rise from 4,500 is less percentage-wise than 3,400 to 4,000, and it gets easier as you go up. But if it were that easy, we'd all be millionaires by now.